Taimur, thanks much for taking time out. Just wanted to get in a sense as to how you're looking at the overall global setup at a time when, yes, we were talking about that Trump rally having fizzled out, but now looks like we're on track for a winning streak. You've had the jobless claims coming in, and the fact that the dollar is holding out close to two-year highs. What is the implication of this?
The implication is a challenging one for emerging markets in the near term. I'm not particularly worried about the medium-term narrative. I don't think this Trump trade would undermine the medium-term narrative of the growth that is coming out of India, that is coming out of Southeast Asia at all. But there is a lot of noise near term, and that is rather unambiguous, meaning strong dollar is a negative for EMFX. It is a problem for EM lenders of foreign currency. Going into 2025, those who were looking to do debt refinance or debt raising, both interest rates and the exchange rate angle would be more challenging. I think there is no question about it. But in the region, when we look at demand for exports, for example, looks fine. I don't know whether there's some noise around it because people are front loading trade in anticipation of the tariffs, but the fact of the matter is that we have pretty decent momentum on exports going into 2025. Regional travel, tourism, services look very good. Therein lies a parallel between our part of the world and the West. Services are doing very well. So I think that near-term equity market outlook, near-term Asian effects, and of course, the near-term interest rate outlook. Those are challenging backdrops. I don't think they're going to be substantive enough to undermine the medium-term outlook on which we remain fairly constructive.
Is there a way in which we can really establish that how long this Trump 2.0 trade will continue? Because in my mind, it's just a trade. I mean, economy is going to take a time before it actually turns, but markets are excited way ahead of it.
Right. I mean, markets are doing exactly what they did in 2017. At that time, of course, Trump didn't get elected and immediately imposed tariffs. So I think this time the market is thinking that we should just take him in face value, that day one of his presidency, large tariff measures will be announced, and hence it would be negative EMFX. So let's just be short EMFX in November of 2024 going into January 2025. I think that's what manifested in the last 2.5 weeks. We've seen relentless strength, and the speculative position data show that large portion of the market that was sort of neutral to US dollar has become bullish US dollar. And combine that with the interest rate outlook, which is independent of Trump. The current US economic fundamentals are driven by policy of the last 4 years, and they are looking very solid on the investment side, on the consumption side, on corporate and household balance sheet, very strong data. So the Fed having cut by 75 basis points is looking, rather, premature in becoming very dovish, and hence the market is pricing out a lot of the Fed rate cuts. You will remember that 8 weeks ago, 10 weeks ago, we were looking at 10 rate cuts in this cycle, if not more. I think that's all been scaled back. Then again, it's a big US dollar positive development. So I would not conflate everything that is happening in the markets with the Trump trade. There is this notion of the Fed itself, whether it was premature in cutting.
So are you saying that the Fed doesn't have enough cushion to cut rates again in December, Taimur?
We still are calling for it. And I think in that we are with maybe 60% of the market. But I think there is a growing voice out there. And Powell's recent communication itself lends some credence to that voice, that if we get a pretty strong CPI print, by that I mean no further inclination of inflation heading toward 2.5, but headline hanging around the 2.7 range, I think that would give the Fed some room for pause, meaning no Christmas gift for Americans, but maybe a gift for Trump in the next meeting after he becomes president. And until then, the Fed would have to take a strong look at the data. The key question is there a part of the US economy that is crying out for lower rates? The answer seems to be no. Despite high rates, we have seen no major pickup in delinquencies as far as borrowers are concerned. Despite high rates, we haven't seen any major sell-off in the fixed income market. 10-year has retrace some of its gains from earlier, but again, we're not talking about 5% rate. We're talking about mid or low four handle. That is okay from the Fed's perspective, and equity market is going rah-rah, risk on mentality all over the markets. So the question is there any urgency for the Fed to deliver one more rate cut? I still think that they would just want to keep doing what they have been doing earlier, but I am going to be quite unsurprised if I'm proven wrong.
Okay. We'll chat again in December and figure out what the Fed actually does. But Taimur, good to have you on the show as always.
Thank you very much. Bye-bye.
If you like this video, then like, share and subscribe to ET Now.